Welcome to the Computer Money Magic Forex program. Today we're going to talk about Interest 101. Our agenda is going to be bank interest rate, Rule of 72, simple interest, compound interest, market interest rate, and then we're going to talk about compound interest compressed. All right, so bank interest. According to www.depositaccounts.com, the highest interest rates for 2020 online, wait for it, is 1.15%. Daily, you say? No, that's annually. So, where do I sign up? Now, check out this laughable statement, which is at the top of the same page. Grow your savings faster and earn up to 9 times the national average with these recommended banks. And I'm not even going to give you the pleasure of seeing what those banks are. But let's talk about the Rule of 72. So, according to Investopedia, the Rule of 72 is a simple way to determine how long an investment will take to double given a fixed annual rate of interest. By dividing 72 by the annual rate of return, investors obtain a rough estimate of how many years it will take for the initial investment to duplicate itself. So let's use the rule of 72 on 1.15% annual rate. So 72 divided by 1.15 will take you 62.6 years of compounding your money and never touching it to even double your money. All right, now who's up for that? 62 years. So let's talk about compound interest. So what does that actually mean? According to Investopedia, compounding is the process in which an asset's earnings from either capital gains or interest are reinvested to generate additional earnings over time. This growth, calculated using exponential functions, occurs because the investment will generate earnings from both its initial principal and the accumulated earnings from the preceding periods. So compounding therefore differs from linear growth, where only the principal earns interest each period. So remember that rule of 72? If we take 72 divided by 1.15, it'll take 62 years compounding your money. But you got to remember, you can't take out anything. You can't even touch a dime. So here's a chart, but instead of using 1.15%, let's use 10% to make it a little bit more exciting. So if we take 72 divided by 10, it will take you 7.2 years of compounding your money and never touching a dime in order for it to double. So if you see here on the chart, um, where this you get 10% interest on the first year, you make $100. That gives you $1,100. The second year, you start off with $1,100 at 10%, you actually make $110. That yields you at the end of the year $1,210. So on and so forth until you get down to the eighth year, which you'll make a obviously doubled your money at $2,143. So, are you excited yet? You can double your money in 7.2 years. So let's talk about the stock market. So you look at the stock market and you say, surely I'll make a killing there. That's where my 401k is. That's where everyone is investing and everyone is making a huge return. Well, again, according to Investopedia, the average rate of return on the S&P 500 was approximately 10 to 11%. Now, that is from the period of 1926 through 2018. The average rate of return since adopting the 500 stocks into the index in 1957 through 2018 was only 8%. So let's say you invest that $1,000 and in 7.2 years, you'll still double your money based on the 10% um, average rate of return on the stock market. Now, What they don't tell you, there's an inherent problem with the stock market. They don't really talk about it. You have gains, but you also have losses. So here in this particular chart, we still have a 10% rate of return, but we had two really bad years. And just to get to that 10% return, I had to throw in a really great year of 80%. And you're not really going to get too many of those in your lifetime. But if you look again at this chart, we're still behind about a year or two because at the end of 8 years, we have only $1,600 instead of doubling our money if we had a linear or a steady rate of return at 10% each year. So as you can see, those losses can really kill the gains and set you back a few years. So what's the point? One of the points is that we need to have steady and consistent gains. And then, where are you going to find those? So I also need you to understand the magic of compounding interest. Hopefully I kind of explained that well. And then you also need to understand those cards are kind of stacked against you. The banks are only giving you 1%, but yet they're loaning out their money at 5, and if you get a credit card, it's 21%. Um, so there's got to be a better way. So with computer money magic, there is a better way. Look at what happens if you can condense that cycle down to every 90 days instead of 365 days. Using the same charts and the same returns that we had before, you can see the difference. You can make the same returns in 2 years versus 8. So now you should be getting a little bit more excited. So we have 8 cycles here in the quarters. It's 1, 2, 3, 4, 5, 6, 7, 8. And then you can see here years 1 and year 2. And we have the same thing going on at a 10% rate of return. We still double our money, but now it's in 2 years, I'm sorry, instead of 8 years. Okay. Now, what happens if you get a slight increase of 15% every quarter? Again, now what you're looking at, same chart for 2 years every quarter. You get 15% per quarter. Now you're looking at almost tripling your money in that same amount of time in only 2 short years. So again, what's the point? Why do I care? We all know you get higher rates of return, you can get better money. All right. So here's a chart of one of the accounts which had achieved exactly that 15% rate of return, a total profit of $76.42 from the initial $500 deposit. So that's great, right? We get 15% return. So if we look a little bit closer here, um, we actually see why you need to get excited, because the research that is being done is truly outstanding. First, the start date of the initial deposit was 4/7/2020, and the last closing transaction date was 6/5/2020. So that's only 59 actual days. Um, and at these numbers, it'll only take one 1 year, 4 months to double the initial deposit for the future research of the robot's performance. However, if we take an actual closer look at the findings of the actual data, we find that there were only 122 trades during a 60-day cycle. So that's only 2 trades a day. Basically, the robot wasn't even operational. So in reviewing the trade data, the robots only actually traded 10 days out of the 60. Now, again, using those averages, if we were to get the robot to trade every single day, in April, the average profit was $9.78 per day. In May, the average trading was $7.79 per trading day. Now, knowing that we can set the robot and set those parameters and to run 24 hours a day, even if he only made $9.78 a day and $7.79 a day, throughout that whole 60-day cycle, we would have a grand total of approximately $527. So that more than doubles your initial deposit in 60 days. So obviously, past performance does not guarantee future success. However, if you're not excited now, it's going to be hard to get you excited. Thanks. If you have any questions, please reach out to your assistants.